One of the largest names in the space, Circle, is going public via a SPAC.
I'm rooting for that SPAC.
It's one of Wall Street's hottest fads.
No one quite knows exactly why the market for SPACs exploded.
From A-Rod to Trump, it seems everyone is getting in on it.
Volume from Thursday, unprecedented for a SPAC.
But what exactly is a SPAC? Let's get into it in today's Word on the Street. SPAC stands for Special Purpose Acquisition Company, sometimes called a blank check company. It's a shell corporation set up by investors with the sole purpose of raising money through an initial public offering to eventually acquire a private company. Still following? Basically, it's a fast-tracked way to make a private company public without going through the traditional IPO process. Here's how it works. First, a management group made up of sponsors decide to form a SPAC. They raise money through an IPO, selling units to investors. Now keep in mind, investors don't know what they're getting when they buy in. The SPAC at this point has not targeted a company, it doesn't have a product, a track record, or assets beyond the money raised in the IPO. So they're really putting their money behind the management team, betting on them to find something great. A blank check, if you will. Morningstar editorial manager Ruth Saldana says recognizable sponsors are a big draw, from celebrities to venture capitalists.
There have been investors who have done successful SPACs in the past, and therefore the investor thinks that this is a good time for us to get into this at the ground floor and maybe make a lot of money, and so that's why they're perhaps flocking to it.
Now, all the money that's raised from investors goes into an interest-earning trust. Sponsors have up to 2 years to acquire a private company they think has tremendous upside to take it public. If they don't find a company in that time, the SPAC dissolves and investors basically get their money back. If they do find a company, the SPAC and the private company merge into one publicly traded company. At this point, initial investors can decide if they like the merger and want to stay invested or pull out their money. Now, sometimes it booms and makes initial investors rich, like when the SPAC Digital World Acquisition Corp announced its merger with former President Donald Trump's media company.
800%, pushing the SPAC valuation beyond $8 billion.
And sometimes it busts, like when Southeast Asia's ride-hailing giant Grab lost more than 20% of its value its first day of trading.
It's the biggest SPAC deal ever, and it sort of landed with a thud.
Professor Jay Ritter is known as Mr. IPO for his extensive work in the field.
So it's not a one-size-fits-all where every company decides that merging with a SPAC is the right way to go. But obviously, hundreds of companies are deciding to do it, so it's got some attractions.
The number of SPAC IPOs has exploded the past 2 years. One draw for private companies is that it's a much shorter runway to public.
Now, for a traditional IPO, it could take anywhere from 6 months to well over a year for a company to go from private to public. But in the case of SPACs, that has been crunched down to just a few months.
But perhaps the difference that requires the most scrutiny comes from regulation. While a traditional IPO puts all the financials on the table, the SPAC process is more private, so investor risks might not be spelled out. That's one reason the SEC is now taking a closer look at SPACs.
The SEC doesn't try and decide for investors, is this a good deal or a bad deal? They just want to make sure that investors have enough information to be able to evaluate a deal.
And now that you know the deal with SPACs, what other terms do you want to hear about in our Word on the Street? Drop it in the comments.